Okay, it is 11 o'clock, so we can get going, I think. So, my guest this week is Matt Cable from Rights and Issues. So, we'll be talking to him in a minute. But first, there is a lot of news to get through this week. So, 6 things that I've pulled out there, starting with Downing, which is from this morning. So, there's the chart. That's obviously taken from last night, so it's unaffected by this morning's news. Obviously, the discount is way too wide. We've been moaning about that for ages. The yield is very attractive. And it would have liked to have been an awful lot bigger than it is. But unfortunately, this discount widening started before it could get that done. Despite the fact it's actually got a very good track record. So what we've got this morning is a bid for it by an outfit called Bagnall Energy. And it's a cash bid, so 102.6p. Which is a decent premium to last night's closing price, but a 7.5% discount to the NAV after this dividend that's going to be payable on the 27th of June. Because obviously it's earning money and the NAV will be going up. If things aren't wrapped up by the 31st of August, there will be another half p dividend before the deal goes through. So this looks like it's going to happen. Bagnall has already got a big stake in Door. It's a fund that's advised by the same manager as Door anyway, Downing LLP. So if you were trying to come in and compete with this, you'd have to have a sort of suitable management team to try and take this away from them. And remember that they've got this specialist team running the hydropower assets that would be very hard to replicate, I think. So they are the natural manager of this thing. They've also got support from holders of another 16.8%, and the board recommending it. So this looks to me more or less like a done deal. Obviously, it would be nice to get closer to asset value, but this is where we are. The way it's structured, it's a scheme of arrangement. It needs 75% of shareholders to approve it, of those voting. If it looks for whatever reason like that might be tricky, then Bagnall can switch to doing this via a takeover offer, like a normal takeover panel type takeover offer, and then it needs like 50% to take control. But as I say, it seems like this is going to go ahead anyway. I'm a bit miffed about it, to be honest, not because this isn't a great deal for shareholders, but generally because we've been moaning for ages. This is a great company, great management team, great track record. They've done everything they said they were going to do. There's no good reason why it's trading on such a big discount. It ought to have been trading at asset value and it ought to have been growing. And this is the next worst option, I guess. So it's just a real shame. Syncona next. This has been truly dreadful. And I should probably point out I'm a shareholder of Downing and also a shareholder of this one too. Which is not one of my greatest investments. But there we go. On a 45% discount at the moment. And still a decent size after all that, because it was quite a big fund at the beginning. So it's now saying that it wants to adopt a managed wind down strategy with the aim of maximising value over the medium term. So obviously that means no new investments. They will have they've got quite a lot of cash on the balance sheet. They want to support existing investments in the portfolio. Some of these, because a lot of these are cash consumptive companies that are trying to run clinical trials and things, they do need that money. There are some external investors that can help with that, but Syncona would like to follow its money and not get diluted. So all of that all makes sense. So there's no clue really as to what the size of a payment out of the existing cash pot might be, but there might be some. The wrinkle in all of this is this bit at the bottom. So they are talking about selling part of the portfolio at what would be a really chunky discount to NAV from what they're saying there. A modest premium to the current share price, where this is a 45 discount and a discount to NAV. So this is massive destruction of value for the fund. And what really annoys me is the buyer of this. So they're talking about creating a new private investment vehicle to be managed by the existing manager, which may be spun out as a separate entity, and we're going to have to watch carefully to make sure that there aren't snouts in the trough around that. Institutional shareholders will be able to roll over their investment into it. External investors will be brought in too, and then it would be the entity that would buy the assets from Syncona. So they're basically, what they're doing is starting off the new fund with a great deal by buying assets at way bigger, way too big a discount to NAV. Gives it an immediate uplift, which makes it look great from the off. Everybody's wonderful, apart from small shareholders like me, like many others out there, who wouldn't be able to participate in this and would be missing out. So I think this is really bad news, and I will do what I can to oppose it. Henderson European. Well, there's the chart for Henderson European, and you can see the uptick in the share price at the end, so they're very small there, down to 3.8 discount now. There's Fidelity European, and obviously the news is that the two of them are getting together. So in terms of the performance track records, there's not a huge amount in it actually. I mean, obviously Fidelity European has beaten over 10 years, but not by an enormous amount. BlackRock Great Europe is actually ahead of it, but still, if you are Henderson and you're looking for a merger partner, then it's not a bad option. I think actually probably a very good option. The history of all this, how this has come about. So we go all the way back to 2023. So Henderson had two European funds, one of which was Henderson European Focus. John Bennett, who's a very well regarded manager of that fund, decided to retire. He'd been running it for 13 years. He'd been veteran in the industry for more than 40. And so that's created some unease amongst shareholders. So Henderson decided the best thing to do was to knock together the two European funds, and the boards agreed to do that. So that was announced in March, but they actually needed to sweeten the merger terms of that in May to actually get the deal across the line. And then it ended up with this enlarged fund being run by Tom O'Hara and Jamie Ross. And then in February, it turned out that they were leaving Janus Henderson, and obviously that was a big blow, and the board were understandably upset. So they immediately launched this strategic review, and the outcome of that is the merger with Fidelity European. In terms of the practicalities of this, it's a normal Section 110 scheme. We've talked about these a number of times. There's been a lot of them now. Fidelity is the one absorbing Henderson European. There is a cash alternative, and it's really quite generous. So it's a third of the trust, 33.3% of the trust, at formula asset value, which is NAV less the costs. Less 1.75%. So I think that's actually not a bad deal. If you want cash, then go for it. You might end up getting out more or less at the current discount, I would have thought. Although you could, if you wanted to, try rolling your money and then selling Fidelity European, but I think probably you want to take the cash box if you want out. Even if that gets taken up in full, and I don't think there's any guarantee that it will do, but if it does get taken up in full, this trust is still going to have more than £2 billion worth of assets, so it will be a proper champion for the sector in Europe. Run by the same team at Fidelity that have been running the fund forever now, Sam Morse, and there is a deal with the manager to inject money via a fee waiver to cover a lot of the costs. So they're saying about 2.4 million quid. Which translates into covering all of Fidelity European's costs, as you might expect, and then some of Henderson European's. We don't know what those are going to be. They've already got 33% of HET shareholders saying yes, we want to do this. So again, I think this looks like a done deal, and I think this looks like a good option. The new fee arrangements, they are cutting the fee. Again, this is good news. It's a new tiered fee. That sort of 400 million tier looks a bit redundant now, but there we go. And it could be done quite quickly. So they're talking about meetings in September and wrapped up by the end of September. So as I say, this will almost definitely happen. Gore Street Energy Storage next. Again, we know the whole story of this and the way that the discount widened out, and the fact it's been narrowing a bit more recently, which is good, but still way too wide, and that means it's on a high yield. They've just published a new NAV, and that wasn't great. A lot of these funds, a lot of the new energy funds, are still getting a hit from power prices, and they do feed through a bit into battery revenues as well, because if you're basically trying to arbitrage the swings in power prices and the top end of that is coming down, that does reduce your sort of available income. So they're saying that's going to take about 6p off the NAV. But because they brought a lot of assets online and they were valued on a discount rate that reflected the construction risk, the new discount rates would be lower than that, and that lifts the NAV up. So we did see an offsetting gain from discount rate movements. In terms of dividends, so if you remember, it's been paying a penny a quarter, then it said would pay more if you got the investment tax credit money in from the 2 US battery storage projects that have been brought online. So it's had the Dogfish money already. The Big Rock money is still coming, and they're saying it looks like it's going to be top end of the range, which I think is about $50 million plus. So they're going to use some of that to pay a 3p dividend. So that basically means you get 7p for the year, which is good news. But they're saying that going forward, the dividend is going to be more reflective of what the company's earning, which makes much more sense. So you won't have this sort of an NAV sort of through chipping away thing. Also helps you're going to have lower fees because they're shifting to this 50-50 NAV market cap basis, which some of the other renewable funds have done, which is all right, but I don't see why they don't go the whole hog, but there we go. There is no performance fee anymore. You probably didn't know there was a performance fee because I don't think it's ever earned one, but there we go. And it's still 12 months notice in terms of having to fire the manager, but there's no termination payment in the event of a takeover. And given what's going on, and Harmony and now Downing Renewables and all this other thing, that's not completely out of bounds. So the fee saving is well over £1 million a year, assuming the discount doesn't narrow. Obviously, the discount narrows, then that disappears. But that's still quite useful and will help towards the income. So they're going to use what's left over from the cash from Big Rock to pay down the debt, and they're just going to sort of sit on lower debt for a while they talk to shareholders about what should happen. They've brought in an external advisor to look at the pipeline of assets that they've got. So they'll be weighing up how much money can we earn out of those versus how much is the benefit of buying back stock. That's more or less the calculation they'll be doing. But they're also going to be looking at the sort of more strategic options, things like should we do a merger, should we dispose of part of the portfolio, should we do big tenders, all that sort of thing. So this story is not finished yet. There's more to come. It's going to be interesting to see what happens. I do think their dividend is more or less likely to fall from here. I do not have much clue of what value you can really put on the US pipeline, given what's going on with Trump and this sort of rolling back from the Inflation Reduction Act stuff that Biden had. I think it might be harder to monetize those things, but they've got plenty of other opportunities elsewhere. And Hansa Ocean Wilson's next. So Hansa's not a massive company, 300 million market cap together. The odd thing about it is it's got voting shares and non-voting shares. The voting shares are all controlled by the Salomon family. That makes it bid proof. They don't seem much bothered about the discount. That's the reason why the discount is enormous. They're also not much bothered about getting an income, so the yield isn't very high either. So I've never been a particular fan of it. It's had a stake in Ocean Wilson's for a very long time, and Ocean Wilson is an investment company, but not an investment trust. It doesn't have that kind of tax advantages. And it's got a very similar portfolio to Hansa, apart from the fact it used to have this big investment in a Brazilian ports and logistics business. That got sold, and that actually deal completed on the 4th of June. So that means that Ocean Wilson's is quite cashed up. It's using some of that cash to do a 20% tender for its stock, and that's like a reverse Dutch auction. I think we might have talked about this before. So once that's done, it'll look a lot more like the Hansa portfolio, but we're still with some cash, I think. So they're going to knock the two together. The idea is they're issuing voting and non-voting shares, which I thought was a surprise. But actually, there are kind of insiders on both sides of the trade. It's done on the basis of formula asset value, so NAV less cost of the transaction. That's all you get calculated at the end of the month. It's all been done under Bermudan law because they shifted the domicile to Bermuda, which I think was a way of making sure they never had a problem with somebody coming in and saying you can't have non-voting shares. So I think, again, this is a done deal, really. They are cutting the fee, which is good. There's a concession to that. And that's reasonably chunky because it was 1%, it's going down to 0.8 and 0.7. And the other thing they're doing is they're saying they're going to buy back between 2 and 4% of the shares each year. I don't think that's going to make any difference to the discount. And the share price of the non-voting rather has jumped a bit this week, which is good. But I can't see any other catalyst to get this going, really. So I wouldn't be piling in. Lastly on here, Mega Opportunities. Obviously not very big, but very well liked. Trading on reasonably tight discount because they've got a discount control mechanism. But it's really synonymous with Nick Greenwood, and he's been running it for many, many years. He's been running it with Charlotte for a long time too. She's going to stay on as co-manager as Nick moves into a consultant role at AVI. And Tom Trainer, who we know from AVI Global, is going to become co-manager with her. And in conjunction with that change, they're going to kind of shift the investment approach. So they're going to have a much more concentrated portfolio of things that they are trading on B discounts, where they think they can influence boards to get that discount down. So it's becoming a much more openly activist fund than it was. They don't want any kind of comparison with Saba, and I understand that. And so, commendably, they've said this is, to avoid any accusation that we're going to be asset gathering, actually meaning in there, we're going to basically hand back assets above 150 million to you via tender offers or dividends or whatever they can. And they're also going to have a regular 3-yearly exit opportunity that they're going to maintain that existing structure. So that will help keep the discount down too. They are cutting the fee, but they're introducing performance fee at the same time. So again, this is all about incentivizing the manager to achieve decent returns, and the hurdle rate that they've set themselves is SONIA, which is the equivalent of LIBOR, plus 3% per annum. So if they earn more than that in a year, they'll get 15% of the excess will go to the manager. But the fees are capped at 2.5% each year. So with the normal market, normal base fee plus the performance fee can't be more than 2.5% each year. And quarter of that money, the performance fee money, will be reinvested into the shares. So this all makes sense to me. It's quite a good outcome, I think. There's a kind of parallel, because basically if you think about AVI Global, it's got holdings in investment companies, a bit like Migo. It's got holdings in Japan, a bit like AVI Japan. But AVI Japan, because it's smaller, can hold smaller companies. And the same thing here with Migo. Because Migo is smaller, it can hold smaller companies than AVI Global can. So sometimes there'll be an overlap in the portfolio. Sometimes it'll be stuff that only Migo can really afford to do. That all makes sense too. And I thought, because these are all now presumably in play, these are the ones that it's currently got big holdings in. Chris's, we know, is also the biggest holding, I think, or one of the biggest holdings in AVI Global. And obviously there's stuff going on there. If they ever get the Klarna IPO done, there'll be cash returns, hopefully, and all that sort of stuff. And then, they've got this ongoing capital management policy, and we are working with them trying to drive the discount down, which is good. PRS REIT is almost a done deal. So that's always been some takeover offer. There's plenty of other stuff on there. VH Global's already implemented and managed wind down. Oakley is hopefully any minute now shifting its main listing from the specialist fund segment to the main market, and I think that will make a big difference to its rating. Credit European News is already in wind down, so too is Spring Spray. So basically all of these things is very interesting stuff, but watch what happens within its top 10, because that will tell you where they're going off to next. So I've run over way more than I normally do. It's time we brought in Matt, I think. So,
morning, James.
Yeah. I want to let you drive. So thank you very much indeed. I'm going to hand over to you for a bit, and you can tell us a bit about rights and issues.
Thanks, James. Well, morning, and thanks for having me. There is a lot going on today, as you say. I'm going to give you a quick intro to the company. You've got there the sort of standard fund overview slide, which is a little bit dry. So just to give a bit of context and a sense of perhaps some more pertinent facts and figures. So Rights and Issues is about a 125 million net asset value investment trust. It's made up of 22 UK listed stocks. The focus of the company is UK smaller companies. Current market cap range is from just under £50 million up to about £5 billion. But the focus of new holdings is, and the ethos of the company is around the sort of the bottom 10% of the UK market by value. So that aligns with what's now the Deutsche Numis smaller companies index. The company's had a fairly strong traditional focus on industrials, and one of the things that we've been doing at Jupiter is balancing that out a little bit more. So there's still a tilt towards industrial companies, but it's less than it was 2.5 years ago when we took it on. And on that point, just a quick word on the history. It traces its roots back to 1962 when it got its name. The Rights and Issues name doesn't now particularly relate to what it does. But for most of its existence, so for nearly 40 years, from 1984, it was run by a chap called Simon Knott, who ran it pretty much as a one-man band. Simon is still on our board. He's still our largest shareholder and is still a font of knowledge on quite a lot of the holdings. But Simon decided in 2022 to take a step back from managing the company, and after a process, the board appointed Jupiter, initially under Dan Nichols, and then after Dan's retirement last year, I took over lead management, and I'll introduce you to the rest of the team in just a second. The trust, the company pays a dividend. Obviously, I can't give you any forecasts, but if you take last year's dividend divided by the current price, the yield's just over 2%, and it's currently trading on about a 20% discount to NAV, and has been through the early part of this year. So very quick introduction to the team. This is the Jupiter small and mid-cap team led by Tim Service, who has been in the industry a long time. Tim runs our mid-cap funds largely with James there, and I look after the small-cap funds. We're supported by Claudia Howe as an investment analyst. It's worth saying, though, that one of the other things that's been happening at Jupiter over the last year or so is a significant expansion of our UK equities, broader UK equities team. So despite all the sort of the doom and gloom that we hear about our sector, very much a commitment to it. We now have 13 UK-focused equity investment professionals. And I was just totting up across all their bios, or our bios, yesterday, and I believe between us we have 263 years of investing experience in the UK. So lots of grey hair, and in some cases increasingly grey hair on the team. And then we're supported again by the wider Jupiter investment platform, so very much a full service platform supported by dealers and risk managers and so on. So as a team, we look after just a bit under £1 billion of assets across essentially 5 different strategies. So the 3 mid-cap strategies on the right, and then the 2 smaller company strategies on the left, being the open-ended funds, Jupiter UK Smaller Companies, and Rights and Issues, obviously as our investment trust. One point I will just make on here, as you'll see here, the benchmark is listed as the FTSE All Share. That's a very long-standing feature that I think that's more or less since inception has been the formal benchmark. In practice, the board has made a long-term strategic decision to focus on smaller companies, and from my perspective as investment manager, I'm measured against the smaller companies benchmark, so the same benchmark, Deutsche Numis smaller companies benchmark that we use on the open-ended funds. That's how I tend to think about it. And the philosophy here, as it says in the top right-hand corner, is essentially that we run one investment approach, one investment philosophy, and then apply it in different ways, ranging from a relatively tactical approach on the right-hand side in our specialist equity fund, which is a long-short hedge style approach, through to rights and issues, which would be the other end of the spectrum, where it's a much longer-term, high-conviction approach with a concentrated portfolio. So obviously what I'd like to talk a little bit about is philosophy and process on investing the company's assets. Given the time, I'm not going to go through all of this. I'd like to spend a bit more time talking about the stock picking process, which is one of the four sort of core principles that we apply. Just very briefly touching on the others. So we do bring a top-down element into our thinking, but we treat that very much as macro-aware rather than macro-led. And what I mean by that is we do think about and care about geopolitical events, macro indicators, so interest rates, inflation, and so on. But we're not trying to gain an edge or to take a view on those things. So we really apply them in two different ways. One is as they apply to investee companies. So we'll talk to management a lot about the impact of tariffs or trade disruption and so on. And then we think about them from a portfolio perspective, largely aimed at neutralizing unexpected tilts in the portfolio. And that relies very heavily on that bottom right-hand box on risk control. So we use a number of proprietary and off-the-shelf risk management tools that we're essentially using to make sure we understand risks in portfolios and to the largest extent possible only expose investors to those risks where we believe we have some sort of insight or edge, which particularly in the case of rights and issues will almost entirely be stock specific. And then we aim to be very open and clear in what we're doing. In the case of rights and issues, that's fairly straightforward because we publish our full portfolio every day by RNS, so you can always go and see exactly what we own and what we've been doing. So just zooming in a little bit on stock picking, which is obviously the core of the process and the really important part for rights and issues. And essentially, we have a fairly straightforward philosophy, which is we look for three different things in an investment. So the first is growth. We believe that in the smaller part of the market, what ultimately drives value is growth. So we're looking for businesses that have those characteristics that allow them to grow faster than the market in a sustainable way. And I'll come back to that. We're then also looking for, we describe it as upgrades, but effectively what we mean is growth that isn't fully appreciated or forecast by the market. So that might mean just not in sell-side forecasts, but often it's also where there's a degree of skepticism about that amongst the wider market. And we spend a lot of time thinking about and trying to understand what the market is actually expecting from companies. And then what we believe is if you can find those things, we can often earn a re-rating as the business becomes, that growth becomes better appreciated by the market. And as you can probably see, what we're really looking for is the combination of these three things. So companies with attractive growth characteristics that aren't fully appreciated by the wider market. And then when they are better appreciated, we earn a re-rating on top of the growth opportunity. Clearly all easier said than done. So how do we actually approach that in practice? And this is really the sort of the shoe leather, the deep due diligence, the time we spend working with companies and also to a large extent with sell-side analysts and channel checkers and so on. And it's worth saying that really the two areas that we spend most of our time thinking about are management caliber and business quality. So we think, again, at the smaller end of the market that management make a bigger difference than perhaps some of the sort of larger businesses, which to a certain extent are what they are. So we'll look at some sort of, the hard things like experience, people's skill set, track record, but we'll also look at some of the softer things. We believe that things like integrity and resilience are extremely important at the smaller end of the market. And we do spend a lot of time thinking about alignment. So we'll look at incentive structures and so on to make sure we understand what it is that management are actually incentivized to do. Business quality, to a certain extent, this is sort of a statement of the obvious, but it's understanding products, brands, market positions, and so on, those fundamentals that drive business quality and hence growth. Clearly, to a certain extent, that's business model specific. And we do quite a lot of channel checking, so trying to understand how customers, suppliers, staff, etc., feel about a business and what they're saying. The setup is worth mentioning because this really comes back to that point about re-rating. So this is understanding where the market is with relation to a company. So yes, where sell-side forecasts are, but also what the existing narrative in the market is. And what's always interesting is where that is taking perhaps that glass half empty view that we think might change over time. So that's the process. I did want to say a couple of things about why we think UK small companies are exciting. I am very conscious that this has been done to death, and everyone will have heard this lots of times, both from us and from other people. And look, clearly appreciate that we've been pointing out the valuation discrepancies, particularly with the US, for a long time, and that's proved very difficult to move. I'm certainly not calling anything specific. But what I did want to do is just do that, to have that slight step back and just show you why we think over the long term this is really interesting. And the first point is just around actually the strength of the long-term track record of this part of the market. What this chart is, so this comes from the professors at London Business School who invented the what is now the Deutsche Numis Small Cap Index. And they've obviously got data, you can see here, that goes all the way back to 1955. And clearly, they like to point out that equities have outperformed certain other asset classes over that period. But I think what's actually interesting in this chart is that they create these sub-indices that are focused on different parts of the market, so large cap, mid cap, small cap, and micro cap. Don't have time now to go through all the definitions, but this is the way that they've approached segmenting the market, and they've got the all share in there representing the whole market. And the interesting thing, I think, is that you get this nice slope that demonstrates there's been, over the long term, this return to smallness. And in fact, the smaller you are, the better. Accepting that can be very noisy over certainly the short term, the medium term. Over the long term, that's quite clear. And you can debate why that is, but it does seem to be quite a strong effect. So that's why we think the small end of the market is really interesting. And then this is why we think it's a great place for active management. So what this chart shows is the distribution of returns. This was just over a year to, I think it was last August, for the FTSE 100, which are the dark bars, and for that Numis index, small cap index, which are the light bars. And what you see is that the distribution of outcomes is much more widely spread, more distributed for the smaller companies. And essentially, what that's saying is that for an effective stock picker, for someone who can find the right businesses on the right-hand side of this chart, there's the opportunity to add a lot of alpha. In fairness, it does also mean, as you can see on the left-hand side of the chart, that you can also lose a lot of money. But the point there is that the potential exists for alpha generation. And then this is a little bit of analysis that I like that I've done. This is looking at the outcome of that theory. So this compares across a few IA sectors, the return of the average fund, so that's the sector return, less the relevant benchmark. And so effectively a kind of measure of alpha in the sector, or average alpha in the sector. And what you see on the left-hand side of the chart is the stereotypical picture of a global fund, very liquid, very competitive, very difficult to generate alpha, and the average fund underperforms the benchmark. and a very similar effect in North America. And then as you move across into more regional funds, that effect becomes smaller, but is still negative. EM, where again you would think there would be more range of outcomes, more opportunities to develop alpha. That negative measure becomes smaller. And then over on the right-hand side, you've got UK smaller companies, where over this 10-year period, the average fund actually outperformed the benchmark. And in fairness, if you do this for smaller companies in other regions, you get the same picture. So it's arguably a bit of a proof point that sits beyond the logic that I just showed in terms of distribution of outcomes. So having rattled through all of that, I'm just going to talk a little bit about the portfolio itself and what's been going on. So in fact, this slide is a little bit out of date. So this is actually the portfolio at the end of January, but as I say, the current portfolio is published every day, so you can go and see it on our website or on RNS, and it actually doesn't look that different. So that's probably the first update, which is that clearly, won't be a surprise to anyone, the early part of this year has been very volatile, very rapid changes in direction in the market, and lots of potential to get whipsawed. And as I said, we're not trying to trade around that. That's not part of the process. So actually, we haven't made any major changes to the portfolio over the first part of the year. We don't have any new holdings and haven't sold out of anything. But there has been some interesting news on the portfolio, and actually, if I look at the companies that have contributed the most to both out and underperformance, that's probably the best way to approach it. So on the positive side, and by far the largest contributor to performance so far this year has been Reynolds, which, as you can see, in January was the largest position. And that's because Reynolds has received a takeover bid, which is now a firm bid, at a very significant premium to where the share price was at the time, and more so to where it was in January. Those who have been following rights and issues will know this is a stock we really like. That's why it's at the top of the portfolio. It's a long-standing holding. It's a business transformation story, a team that's come in and really sorted out a lot of the challenges around pension and balance sheet. We've done a great job and have got it growing, and it has an exciting future ahead of it, and that's obviously been recognised now by the market, and hence we've had the incoming bid. The second most significant contributor to positive performance so far this year is Alpha Group, and they have also received a takeover approach. In this case, it's not a firm bid. It's just indicative at this stage, so they're in a period of due diligence at the moment. But I think there's a trend here, and clearly way beyond rights and issues, we've seen an awful lot of bid activity in the UK market. If I'm honest, it's a double-edged sword. I mean, clearly the sugar high that you get on the day of receiving a bid is great, and it's great for performance. But clearly a longer-term challenge, and we may talk more about this in Q&A, for the UK market in general, that we're losing businesses at a faster rate than we're gaining them, and that clearly will ultimately be a challenge. I will just for completeness, the third most significant contributor is OSB, which again is a relatively new holding to the portfolio, and has had some challenges over the last couple of years. So really good to see it finding its feet, coming out with a clearer plan, and then probably benefiting a little bit from some improved sentiment towards the UK market in general, or the UK economy probably in general. On the negative side, a few detractors that are worth mentioning, and the most significant, unfortunately, has been Treat. Again, those who've followed rights and issues will know this has been a long-standing holding, manufacturer of flavors and fragrances. Has some excellent market positions, some very strong IP, and has some very well invested assets that they've been building out over the last few years. But unfortunately, it's still sort of slightly at a scale that they're exposed to shifts in some of the global markets, and particularly over the last year or so to the increasing price of citrus, particularly oranges coming out of South America. Which has caused some of their customers to shift away from citrus to some other flavourings, and has affected them, and unfortunately has resulted in a profit warning this year. I can completely understand why the market has treated it harshly, but we still think that there's probably a lot of value here. It would very clearly fit within some other large global groups and trades now at a huge discount to some global peers. So something that we are sticking with, albeit it has been rather painful. And then the other two detractors to mention, and I'm going to put them together because there's an interesting thread here, are Gamma Communications, which is a telephony provider to UK and increasingly German SMEs, and GB Group, which is a technology business focused on identity verification and fraud detection. Both of these businesses have had a somewhat weak start to the year, which is, we think, largely a macro effect. We don't think would have been hugely important for valuation most of the time. But both of these businesses have been caught up in the exodus from AIM. So Gamma has already left AIM and has just joined the main list in London. GB Group have stated their intention to make that move, and I suspect this will be on the minds of lots of listeners. But just for clarity, the issue here is that the change in the budget last year to rules around inheritance tax means that over time we expect that the inheritance tax fund market for listed equities, which is all in AIM because that's where the rules apply, is likely to shrink over time, and so companies are becoming very cautious about the impact that might have on their share price, and so we're seeing lots of companies announce and make that move from the main market, from AIM across to the main market, and that's creating some pretty severe technical overhangs as the IHT funds have to leave. The silver lining here may be that this is going to create some interesting investment opportunities. Obviously not great for the things we already own, but we are looking at a few situations, things that we don't currently own, which could be really interesting entry points for some really good businesses. Getting the timing right is always challenging, but things that could be quite interesting as that process progresses. So just to wrap it up, the company overall has performed a little bit behind its benchmark so far this year. I think on balance that's largely an effect of things that we don't own rather than the balance of things we do. So a few things that have performed very well this year at the top of the benchmark are things that we would never likely own. So we don't worry too much about that, albeit clearly it's not where we want to be over the long term. So something that we are still very focused on. So I'm conscious of time, so I'll probably leave it there, James, and I'm very happy to take any questions.
Great, thank you very much. So yeah, I think as usual we'll sort of start with sort of big picture stuff. In terms of obviously we didn't get a rate cut this week. Where do you think interest rates are going, and does that have a big impact on the portfolio or not?
So, as I say, our process is not to try to second guess where rates are going. I mean, clearly the voting pattern this week at 6.3 was somewhat dovish. I think the market was expecting it to be a more unanimous view on a hold. So that perhaps indicates a little more caution at the bank around the trajectory of the UK economy. But look, these things can move quite a lot from meeting to meeting, and if we get a huge blow up in the Middle East and a spike in oil prices, which then starts to feed through into inflation, then that's probably off the table. So, it's a cop out, but the simple answer is I don't know. I think what's important from the portfolio perspective is that we do try to understand where our overall interest rate sensitivity is, and to manage that to be as small a number as possible, because it's simply something that we don't think we have an edge on, and we don't want performance to be a function of where interest rates go. It is more of a challenge in a portfolio like rights and issues, where because of the concentrated nature, you can't fine-tune that in quite the same way that we might on the hedge fund that we run as a team, where we'll be trying to get that much more finely calibrated because it has that much shorter term time horizon.
That all makes sense. Thank you. Sort of adjacent to that, there's a question here about the impact that the government's had on the UK market. What's your general view? Positive, negative, neutral?
So some of the things that happened in October were negative, and particularly around IHT. And I think there's a direct impact which is really unhelpful for AIM and for certain stocks on AIM. And there's probably a slightly broader thing, which is I don't think those consequences were intended, and they arguably displayed a lack of understanding of what they were doing, and that I think does unnerve people, because it suggests that the government either hasn't done its homework, hasn't talked to the right people, or isn't listening. And I think that that's a fair criticism. I think longer term, and perhaps slightly bigger picture, that there is a movement going on, and it's partly being spearheaded by the LSE to address this broader question of de-equitisation in the UK. And there are lots of different strands to that. So, there's some quite important dull-sounding things going on with listing rules and governance rules, and the suggestion that some of the more painful parts of MiFID II might be rolled back. And then there's some perhaps more contentious headlines around pension reform, perhaps ISA reform. I'm not sure that any of these things is a silver bullet and will solve the problem, but perhaps as a combination of actions, perhaps even more importantly, as a genuine indication that the government is taking it seriously and recognising this point, which of course we as a sector have been banging on about for years, which the economy depends on a healthy capital market, that has sort of filtered through, and therefore that we're going to see policy aligned to that belief for a period of time. And whether it's these things that are currently bubbling along, or whether it's those plus some other things, I don't know. But that feels like there's a little glimmer of hope there, that at least it isn't being dismissed.
Great, thank you. On that de-equitisation front, something like Reynolds, are these things getting taken out at fair prices, or are the private equity companies getting the steal?
So, again, there's a macro and a micro view here. So, on the micro view, I have to believe that we're getting pretty fair price discovery in this process. So, headline valuation multiples are relatively low, but there are still some complexities with the equity story. There were two bidders in the initial process. One's dropped out. Anyone who might potentially be a buyer of Reynolds knows it's in a process. So there's pretty fair price discovery. Had it been trading at a much higher multiple, would they still have come for it? Is a question that we can never answer. And so the sort of the broader low valuation of the UK market is a problem that it's very hard to calibrate. And on as I say, on a short-term perspective, it's sort of moot, because we can't stand in the way of bids on the basis that the whole market will re-rate at some point. The hope is that as these things happen more frequently, that perhaps a few asset owners might take a bit of notice and come in and buy some of these things in advance, and then we'll see a bit of a broader re-rating. I think given where private equity are at the moment, they're unlikely to be overpaying for assets. I don't think we're getting wonderful value as public market shareholders. But as I say, in terms of finding out what these assets are worth today, it's very hard to argue that there's some much higher valuation out there, because if there was, it would materialise.
Yeah, fair enough. In terms of the process, what's the kind of smallest stock that you would invest in?
So the smallest market cap on the portfolio at the moment is Colfax, which has got a market cap of 47 million. I don't think we'd start there today. We don't think of the lower end in terms of absolute market cap. We think of it in terms of liquidity, and opportunity. So if we've got something that we think has an opportunity to grow quite rapidly, we would dip a little bit lower. I think if I were a shareholder or if I were on our board, I would be asking more searching questions if we were going down below 100 million market cap. But we might feel that we could argue that case for certain things. Equally, if you've got something with a small free float that actually is a nice little business but isn't necessarily going to grow very much, I wouldn't do that at 200 million market cap. So we think about it, as I say, more in terms of opportunity and liquidity.
Yeah, thank you. Couple of stock-specific questions then. So can you talk a bit about IMI, please, and why you like that one?
Yeah, so IMI, it's a long-standing holding, and it is by market cap, it's the largest holding that we have left. And one of the things that we've been doing as a process is steadily taking off the portfolio some of the larger market cap. So you can read into that how we might think about it in the medium term. But we do think of that clutch of UK mid caps at the moment. It does have some of the most interesting opportunities in front of it, particularly around its flow control business. I was actually visiting one of their sites a couple of weeks ago where they make valves that go into submarines. And while it's obviously it's a big company, quite diverse, and any one thing isn't necessarily going to move the needle. It was a real reminder that in the UK we do some stuff really, really well, and they sell these valves. Some of when I say valves, some of them you can stand up in. We sell them all around the world. If you are building a submarine, that you are very likely to buy valves from them, and building submarines is something we're going to be doing more of all around the world. And a lot of their businesses have that characteristic. They're very strong in a number of small niches. So it's been performing well, and therefore, though, as I say, it's a bit out of the market cap range, and over time, I suspect it won't still be in the portfolio as new ideas come along. It's one that we're very comfortable running because we just think it's in a really good place, and doesn't at this stage have a valuation that really reflects that.
Cool, thank you. And then OSB. So the question here is saying lending is quite competitive and it's moving into new areas like commercial lending. Is that something that you are concerned about, or you think that's an opportunity?
Yeah, so OSB's core is in the more complex part of buy-to-let lending, and it is, and it always will be, and that's the bit of the market that is less competitive. There's a long story here, because they got into the somewhat more competitive area of the less complex part of buy-to-let when they bought Charter Court quite a few years ago now. So that's their Precise brand, and that is the bit that's been hurting over the last couple of years. But there were good reasons for doing the deal, because without getting into the minutiae and obscurity of bank capital adequacy, they were approaching a size which was going to start to be a problem from a capital perspective. So they needed to sort of get through that phase quickly. Bulking up made sense. So the real reason to own this, and the reason I think it's a good business, is around that more complex end of the buy-to-let market, where you still need human underwriters. And I've been to their headquarters in Chatham and sat with an underwriter. It was a wonderful experience, because I said to him, if you write a bad loan, do you ever hear about it? How does that? And he said to me, this pile of paper on my desk, those are all the loans I've ever written that are in arrears, and they are my problem to sort out. And I thought that's a business, that accountability is wonderful. They have over the years operated in some other adjacent parts of the lending market. So you mentioned commercial lending is one of them. They pulled back on that quite hard, sort of 21, 22, as interest rates moved, and they took a cautious approach and said, look, we just don't know how this is going to affect loan performance, and we just want to be really careful about it. And it affected growth, and the market took a negative view on that. Was it the right thing to do? We'll never know, because we don't have a counterfactual. They now see a more stable environment, and they are gently moving back into more of these things in order to get growth moving again, and to capture some wider margins. So I'm pretty comfortable with them doing it. I think they have actually done the right thing, albeit it's been a little bit painful from an earnings progress perspective.
Great, thank you. And then I think there's a few questions around the discount. I mean, obviously, I think we should point out that the shares are very cheap at the moment. Do you want to talk to how we can tackle that?
Yeah, so the company has for many years operated a discount control mechanism through a buyback, and unfortunately that was voted down at our last AGM and then at a subsequent EGM, very, very narrowly, but by less than 1% at the EGM. And essentially, we have one large shareholder, and to be clear, this is not Simon, not our predecessor. We have one other large shareholder who has decided to vote against the buyback, and we didn't manage to get enough other shareholders to come to the EGM and vote to support it. So there is a little bit of a standoff, and it's very frustrating. I mean, this is something which, unfortunately, the board has to address. There's not much I can do about it as an investment manager, but beyond trying to deliver performance and attract new shareholders. As you say, right now you can buy this little portfolio of listed liquid equities at a 20% discount, which seems to me to defy all the rules of finance that I was taught when I started out. But it is what it is, and the board clearly have it very much on their minds. They're very focused on it. So I don't know where that comes out, but it's not a situation that it feels like it can persist forever.
Yeah, great. I think that's as most you can say. It's brilliant. So thank you very much indeed. I think we've covered a lot of ground on that, and we'll wrap up there if that's okay. And we'll obviously get you back on again in a while, and we'll be writing another note relatively soon, I should think, too. So thank you for your time this morning. And
great stuff. Thank you, James.
I'll just put up the disclaimer. Very important that we read that. And we will be back next week with one of our panel shows. So we've got two managers in the biotech healthcare space. Obviously, that's been under the cosh recently. We've got an article written by Cherry Reynard on our website shortly. We're talking about this. She interviewed some of these managers. So that's sort of a preview for you. But do tune in next week and see what these two managers have to say about how the sector might turn around. So thank you for your time this morning, and we'll see you next week.